So earlier this week, my agent brought me an off-market deal. It's a duplex. And I love seeing off-market deals. They can work out great. A lot of times they're just what you need. But to be perfectly honest, I'm kind of on the fence about this deal. So today, I'm actually going to do something a little bit new. I'm going to show you all the deal that I've been analyzing over the last couple of days, show you some specific numbers, share with you my strategy, my buy box in a more general sense, and then I'm going to make a call about whether or not to buy this deal. Should be fun, and hopefully I can share with you a bit about how I look at buying deals in 2024, and you can apply those same ideas and principles to your own decision making. All right, so let's jump in. And first things first, we're going to just talk about what the deal is and what my general investing strategy is, just for some context. I have been investing for 15 years, and at this point in my career, I do a few different buckets of investing. So my bread and butter is still long-term rentals. I'm trying to set myself up for a retirement in 10 to 15 years. I also do some private lending. I invest in multifamily through syndications and funds. I own one short-term rental, done a bunch of burrs as well. Earlier this year, I actually started buying more small multifamilies in a new market in the Great Lakes region. And so far it's going really well. I have landed 2 duplexes this year. The market is growing. I have a solid team, and honestly, I'm ready to buy more. And so when my agent sent me this duplex, I was pretty excited about it. And let me just tell you the details of the deal. So it's a side-by-side duplex. Each side is 3 bedrooms, which I really like. I like things that are at least 3 bedrooms. It just commands a higher rent. And it has 1.5 bathrooms, which is also a bonus, especially if you're looking to rent to families or roommates. They usually want more than 1 bathroom. So what's different about this place and why I'm a little on the fence about this is it's actually being renovated right now. Usually I buy things that have some opportunity to upgrade them, whether it's like a full-on burr or just a cosmetic rehab. But this is a fully renovated duplex at $325,000. So I'm thinking it's probably worth looking into. Plus, the owners, when I saw this, estimate the rent to be about $1,800 per side. So this potentially would be above the 1% rule. That's $3,600 in projected rent right now versus a $325,000 purchase price. That sounds pretty good. So let's dig into this a little bit more, because obviously you can't make a decision about what properties to buy based on just rent to price ratio. That's just a rule of thumb. You actually have to do the analysis. So first thing I wanted to know was what kind of renovation has been done. And I'll just list it out here for you. So in the exterior, we have a lot of upgrades, which is great. New windows, new roof, new gutters. That should seriously reduce the amount of CapEx I have in future years. We also have new paint, exterior lighting, and it seems that the siding's not so old. 10 years is not super old. Siding usually lasts like 30 years. Then on one side, we have a new kitchen, half bath and full bath, new appliances and flooring, and then pretty much the same thing in the second unit, new kitchen, half bath, full bath, and the flooring is new. So it's a pretty solid rehab. And generally, when I looked at this, I was getting pretty excited about the deal because I thought, hey, that's less work for me to do. It's hitting the 1% rule. Things are looking pretty good. But I have to do a little bit more due diligence. And when you do that, frankly, that's where the reality checks always start to come in. Like, deals always look great when you get the listing from an agent who says the rents are high and the price point is good. And then you start looking at all the different things that might possibly go wrong and try and do your risk mitigation. And that's where things start to come up. And that's where things started to come up in this deal. So the first thing that I was wondering about when I went to my agent is, why is the owner selling off market? And why are 2 people who just bought a duplex and renovated choosing to sell it instead of hold on to it if it's such a good deal? And what I found out was that these partners are actually dissolving their business because they don't like working with each other. And although that's not necessarily a total red flag or a no-go, I do have some questions about that because they're doing a lot of the work on the rehab themselves. So I'm starting to wonder, like, are their hearts really in this deal? Are they going to do the best quality work? So that was one thing I want to think about. The next thing I did was send my property manager over there to verify rents. I trust my agent, but my property manager is the person who's going to list it for rent. So I want to know what he would put it up for. And the agent was pretty close, but to be conservative, he came back at $1,750. So it'd be $3,500 in rent estimated. Still 1% rule. So I'm back to feeling good about this deal. When I put all these numbers through my analysis, factoring in everything from repairs and maintenance, CapEx, taxes, insurance, everything, I saw that this deal would earn about a 6% cash on cash return, which is not bad for today's market, right? It's pretty darn hard to find any cash flow, even break even cash flow on an MLS deal. So seeing a 6% cash on cash return is pretty good. But you might be thinking at home, 6% cash flow is not good enough. Or some people are probably thinking, go buy that deal. You can't find cash on cash return anywhere. And it brought me into sort of this great debate that we all have as real estate investors about cash flow versus appreciation. What is considered good cash flow? What is considered good appreciation? And I actually don't think this is that big of a debate. I have a pretty simple framework that I use to make these decisions, and I'm going to show it to you guys today. I don't think it's cash flow or appreciation. It's both, right? It's a spectrum. It has to have the right combination of both things. So I'm going to put up this visualization that I often show to people here to just explain it. On the left side, the vertical axis, we have cash flow. And on the horizontal axis, we have appreciation upside. And so basically, with most deals, you have this continuum where a deal might have awesome cash flow, but it's probably going to be in a market where there's not great appreciation. There's nothing wrong with that, but that's your own strategy. Meanwhile, you might go into a market that has great appreciation. Think of Seattle or San Francisco over the last 10 years. Those markets appreciated like crazy, but they had almost no cash flow. Then in between those two extremes, there's all sorts of things. So as you can see, I'll just put some labels on here. If you're buying in that upper area, that's basically where everyone wants to be. High cash flow, high appreciation. Unfortunately, not every deal is going to be up there, but that's sort of where you want to be. Some people want to be sort of on this left side of the graph, which is lower appreciation and high cash flow. Of course, they want high cash flow and high appreciation, but in today's day and age, you're not going to get a 10 or 15% cash flow in a great appreciating market, at least without doing a heavy rehab or some crazy deal finding strategies where you just happen to get a steal. They can happen, but they're not that common. These types of deals tend to work really well for people who want to retire or are trying to reach their financial freedom number and are in it for the cash flow today. On the other end, on the right side of the chart, you see high appreciation and lower cash flow. A lot of younger investors, people who are newer in their investing career, look for these types of deals because they want to build a lot of equity that later they can turn into cash flow. Again, there's no right answer here, but I think the wrong answer is being in that bottom area with low appreciation and low cash flow. You definitely don't want to be there. Where you fall on the spectrum is really up to you and your personal goals, but I'll just share with you my personal buy box and where I like to buy. You can see it pretty roughly drawn in here on basically Microsoft Paint here. So what you see here is I don't look for any deals if they are not above break even. I know some people will buy deals that are high appreciation, even if they have negative cash flow. At this point in my career, I'm not interested in that. I actually also don't like super high cash on cash return deals with lower appreciation. Some people, that's their bread and butter, but I look for something that's a little bit more of a hybrid where it has some cash flow and some appreciation potential. That's sort of how I've created my buy box. And what you can see here is that the cash flow for this deal is actually in range for me. I will buy a 6% cash on cash deal, but it has to have good appreciation upside. And I never really count on market appreciation. I do underwrite about 2% market appreciation, which is actually below the long-term historical average to be conservative. But I like to think that home prices naturally will go up about the pace of inflation, which will hopefully get back down to 2%. But that said, I'd take a 6% cash on cash return if the place is in a great area that I think it's likely to grow. I'm not counting on that, but I would take a little bit lower cash on cash return if it's going to be in an amazing neighborhood where there's a lot of infrastructure going in, or there's a lot of government spending, or businesses are moving there. Then I would consider that lower cash on cash return. Or the other reason I'd take 6% is if there's a chance for me to renovate and drive up value, either in the form of higher rents or in forced appreciation, value add pushing up the value of the property. But on this deal in particular, the upside is kind of unclear to me. So when my PM went and looked at it and said that the rents were pretty spot on, he also said that it's not in a prime area. It's a little south of where we normally buy. It's on a busy street, which I don't love. And I think the big kicker for me that's sort of bothering me is that it was just renovated. So it's not like I can force any value here. And this is probably the best cash on cash return I'm going to get for a while, unless we see rents start to accelerate again. And I don't want to count on that because that's totally out of my control. But on the other hand, it's in a great city and there is some business investment in the area and it could appreciate. But after debating for a while, I will show you guys where I put this deal on my graph. And where you can see is that it is just below my buy box. 6% cash on cash return. Again, I would take it if the appreciation opportunity was higher, but I'm just not buying it. I can't upgrade it. It's not in an ideal neighborhood. And so to me, as is at the current value, it's not something that I would buy. But I didn't give up, and I will tell you what I did next instead. But first, I want you to meet my friend, Dave. Dave literally wrote the book on real estate note investing for BiggerPockets, and his company, PPR Capital Management, wants you to be part of their real estate investment fund. In it, there are no tenants or maintenance or property managers, just headache-free cash flow. Dave and his team at PPR invest in mortgage notes and commercial real estate nationwide. And since 2007, Dave's team, they have never missed a passive monthly income payment. So if you're looking for cash flow and you're an accredited investor, you can get started at investwithppr.com. That's investwithppr.com. Okay, so back to our deal. And what I was saying is that this deal was too low for me in terms of total return, but I didn't walk away. Instead, I just did this yesterday. I asked my agent to offer about 10% off the asking price because when I ran my numbers, I saw that this would get my cash on cash return closer to 8%, which I really like. 8% is really solid right now, in my opinion. And it would give me more equity upside because if you're buying at a discount, it gives you more opportunity for appreciation to take hold on your specific property. And I don't know yet if they're going to take this. I have not heard back yet, but that's where it stands today. And I think if the seller came back and said, okay, we'll take 300, I'm thinking I would probably do this deal. But I want to know what you would do. Would you do this deal as is? Would you run away immediately? Please weigh in the comments below. Thank you guys so much for watching. I'm Dave Meyer for BiggerPockets, and I would love to know if you like this type of video. It's a little bit different. I haven't done this type of video before on the BiggerPockets YouTube, and would appreciate your feedback if you found this valuable and it's something we should do more of. Thanks again.